Hey, everybody. Welcome to Market Mavericks. My name is Gareth Soloway here with Verified Investing. And of course, I'm joined by the one and only Scott Melker and Mike McGlone. And we are here on a Thursday to crush it, to give you guys all the pertinent information, everything you need to know from the good, the bad to the ugly, right? And there's a little of everything, unfortunately, these days for us to talk about. So I guess we talk first about the S&P. S&P, another all-time high today. The party never ends. Today we got CPI. It was a little hot. But then the market looked at the jobless claims, which a lot more people were filing for unemployment. But then the market said, oh, wait a minute, maybe the Fed will cut 50 basis points now, and so markets go up, right? Yields go down. We saw the 10-year lower today and markets go up. Mike, why don't you make some sense of this for us? Tell me what I need to know.
Yeah, well, they're not going to cut 50, unfortunately. But I think that's the point we're at now is, yes, record highs in most risk assets, particularly S&P. But we're basically guaranteed to cut 25, but I think we're at that stage now. The market might be entering a little bit of the dopamine stage where it absolutely has to need those cuts. And there's a few little charts I can show real quick, but just let me show you one, and then we can move on. This is a chart of Fed fund futures in 1 year. What's the expectation? So we're going to be at 3% a year from now once we start averaging the effective rate for Fed funds in September of 2026. It's already priced in. And that's what I show in this little orange chart. It's 3%. The last time we had this type of situation, this is just the actual Fed's funds rate. This is where futures says they're going to go, was back in right before the financial crisis. Went from 5%, dropped down to 2%. And the big difference then was the stock market to market cap to GDP was about 1 point times. Now it's 2.3 times. So here's the point is we're so dependent on Fed easing. We're so expecting the Fed easing. We so need the Fed easing that it better come in the stock market. The question is it front running this? And that's coming, are we going to need more to keep it lofty? But right now, the key risk is we're front running as we head towards that time of year we typically volatility picks up, and it hasn't yet. It's wonderful that we have that VIX at 14.8 and the average, the 200-day moving average is 19.2.
So we're going to get a cut, and markets are pricing in 3 rate cuts into year end. Scott, are you believing that these will all come to pass? Or, I mean, does inflation even matter? Or is the Fed kind of just accepting 3% is the new versus 2%? This is the new normal.
I think it's a weird question when we all know that inflation is transitory. It's not real. I would say that at this point, I would have said no 2 or 3 weeks ago that we're not going to get them, which has been my narrative for years. And we've largely been right here about the lack of motivation to cut by Powell. But I think these job numbers give them a lot of cover to keep cutting if it remains that way. I mean, how fortuitous, I must say, that we get a hot PPI print and a $911,000 job revision all the week before the Fed meeting when there's pressure on Powell to cut. I mean, What were the odds that exactly what we needed to see for that cut to happen all happened in 1 week? I'm not implying that the numbers are false because they've always been false for years now. I'm just saying it's pretty crazy that all of a sudden we have the exact kind of inflation and job numbers a week before to get him to cut. I think he cuts 25. I think I maybe he doesn't cut at the next one, depending on how it goes. The thing is, if they cut and job numbers are sort of okay and the market keeps going up, maybe they pause. I don't know. I think the most important point, and we've talked about it here before, Dave Weisberger makes it all the time, is regardless of what Powell does, we know exactly what's coming in April or May.
Yeah.
Which is a Trump stooge who's going to cut relentlessly down to ZERP.
Yeah, and I agree with you. If you're a conspiracy theorist, this was your golden goose, because
I know I'm really
think about this, right? What was the number? It was reduced by the last year. It was reduced by 911,000, which by the way is 911. So dial 911 for the economy.
The day before 9/11,
which 2 days before 9/11. I mean, come on, what is going on here? So, yep.
Let's just remind ourselves, Trump did appoint Powell. And so that's the key thing. Remember, I did enjoy seeing Chris Waller speak at the Economic Club in Miami back on August 28th, 2 weeks ago. And he was very straightforward. He thinks we need a 25 basis point cut. He pointed out stuff we're seeing in the labor markets deteriorating, and inflation's not really a problem. And he's more worried about the anecdotal. He says everybody he speaks to and the 100 people they survey are just not hiring. The key thing is, though, once you get into that position, no one wants to go down in history as what happened with the difference between Arthur Burns, kind of considered by economists as doing the wrong thing by cozying up with doing what President Nixon said, versus the opposite, President Paul Volcker, who is considered is deified in the space. So even getting into that position to cut real rates real fast, to do that, I think the markets will have to tell them to do that, because you'll see we've already at record highs, and if they start cutting and we stay at record highs and keep going up, that's going to cut back the cutting, because we are at, as I pointed in that earlier chart, we're at 2 times GDP. The stock market is the economy. This has never happened for any Fed. Fed didn't exist. Actually, it did in 1913, but they actually started hiking rates when market got this expensive in 1929. So this is what's different this time, and that's creating the number one thing as far as the wealth effect and stuff. But here may so to me, I'm not worried about that, but I'm going to tilt it a little bit over to the shorter term. Here's what we're doing right now. VIX volatility. VIX is running 14%. It's at the 200-day moving average is 19.2. Potentially start rolling over. The question I want to ask you as traders, and our audience as traders, do you think you're not going to get a chance to sell the VIX at or above 20 before the end of the year? I think that probability is very high. You're going to get a chance to sell the VIX up there. It's something always happens. At the same time, do we think we're not going to get a chance to buy Bitcoin at its 200-day moving average, which is about 100,000 before the end of the year? I think the probability is very high we will. It's the question what happens after that. And to me, this is what we're doing right. We're at that fun stage, that silly stage right now. Oh, we got the easing coming. Everything's great. We've already priced it all in. How much better is it going to get? And then we start getting the reality of what I think happened with PPI and what I think might be happening when inflation metrics will get weaker than expected when the demand pull is not there from consumers. And the employment rate is already starting to tick up. I wanted to show you that one simple little chart on the employment rate. And that is, well, that's right here. This is the unemployment rate. It looks like it's starting a little bit of a bull flag pattern, but I overlay it with the gold to S&P 5 ratio. They always have reverted to about 1-to-1 gold versus S&P 500 and 6% unemployment. Yeah, now our viewers and listeners will say, yes, we said this a year ago. That's what I'm worried about, is the delayed reaction. And the question is, does this process get started as we head to fourth quarter, which means we're going to get a new chairman, a new Fed chairman next year. And if they do start cutting like you suggested, will, because they have to, because once you get to that position, to that level, you don't want to go down in history as your name is mud.
But so looking back at the inflation numbers, we've seen, basically a slight uptick, except for the PPI number, which magically was a negative number, right?
Yeah.
But you said for a long time you do think deflation will come, but how does deflation come until the stock market pulls back? Because the wealth effect, I mean, at this astronomical move, like, I just can't imagine that people are going to be pulling back as consumers. Listen, there are certain groups in the U.S. that aren't invested and they are suffering. I mean, I absolutely understand that, but the spending is coming from people that have large investments in the market, and that just keeps going up.
So I'll end with that. I'll address that and then tilt over to Scott. This is part of what always has happened. First of all, we're seeing deflation in China, significant deflation, 1.8% 10-year note. That's where I think we're going. But it's the number one thing I've been wrong about is that U.S. bond market eventually kicking in. And maybe it's getting started. The 10-year yield's at 4% right now. Last year, it ended about 4.5%. Maybe it's finally ticked down, but there's one key factor holding everything back, and that's the U.S. stock market. So I have two measures. This is U.S. stock market versus GDP, 2.2 times. Same scale is the U.S. stock the S&P 500 versus the MSCI ex-US index. They're both about 2.3 times versus 14 years ago, they're 1-to-1. That is the number one source for deflation, and I also overlay that with gold divided by the T-bond market. T-bonds, treasuries in the U.S. are the cheapest in almost 40 years versus gold. And for this little reversion, which I've been calling for, and I've been wrong, for that T-bond to drop to, which 4.64 is the treasury, it's a drop to 3 or so, it's going to need the stock market to just go down and have a normal reversion. That's the key thing I'm worried about. What triggers that? And right now, everything's all bullish and fine, but that's where I think gold's telling us something's going wrong. Gold this year is up almost 40%. The last year was up that much, was 1979, and CPI was running 10%.
Gotcha. All right. So Wow. So you're looking at a weakening of the US economy, which is going to force rates down. That's going to then eventually bring the market. I guess when the economy weakens enough, it brings the stock market down, which then makes the consumer pull back enough to trigger deflation. And by the way, I don't know if you guys heard, but I think it was this morning I saw that Poland has committed to that 1/3 of their treasury reserves are going to be gold now. And I thought that was a very interesting headline that Poland now you're seeing more and more of these countries saying
and we
we
saw
got to diversify.
Belarus, Kazakhstan, and Kyrgyzstan, for whatever they're worth, saying they're going to start Bitcoin reserves
Interesting. Well,
in the
it's
last 4
starting.
days. Yeah.
It's starting. One thing I want to show you guys this because I think you guys will find this interesting. But if we look at the dollar chart, and I've been following the dollar and doing more and more research on the dollar, we can see on the US dollar, this is the Dixie, the DXY, right? So it's against a basket of currencies. But there was this trend line going back to 2023 that was holding it up. Look at how many times we bounced off of it. And then recently we broke it, and now it's become resistance, right? But what's even more interesting on the US dollar is that you have a trend line that goes back to '08, so right at the beginning of the financial crisis, and that's been holding the dollar up the whole way, and we're right back there. And part of me wonders if at some point here we break this trend line, and does that let the dollar move sharply lower over the next, let's say, few years? And again, Mike, I'd actually be curious about are you viewing the dollar? So a dollar's usually a safe haven asset, but do you think that continues here over the next few years, or does it not become the same safe haven it was?
It's such a unique space because typically, first of all, let's start with what's extraordinarily unprecedentedly bullish for the dollar, and that's what's happening with crypto dollars and stable coins that Trump administration 1.0 didn't figure out, but Trump administration 2.0 figured out, and now the world's shifting towards. It's happening organically. We talked about this years ago that you cannot, I mean, just think of the rest of the world, Russia and China and every other country that hates the dollar. It's like, oh my gosh, there's nothing we can do to stop this. We got to create our own CBDCs. The whole world is going organically to dollar through cryptos. And it's right now only about 300 billion. I completely agree with Scott Besson. That trend's going to continue. It's going to add a zero in the next, who knows how many 5 years, because it's just a better way to hold, transact, and transmit dollars instantly via stablecoins. And once they figure out how you can actually get returns on that, that's a very bullish factor for the dollar globally, and they just can't keep up. But the bearish factor is that chart you showed me, you just showed I can overlay the same exact chart. It looks like if you take the S&P 500 divided by the rest of the world stock market, the MSCI US index, they've both corrected to support. They're doing the exact same thing. So the bottom line is that what's really been coincident with dollar strength since the low in 2009 is the US stock market outperforming the world. So that's the risk, I think, for the dollar. But overall, what does our administration want? They don't say it, but if you want to rebalance trade, a weak dollar is just, you can't do it without a weaker dollar.
Weaker dollar. Makes sense. All right. So turning now to crypto, Scott, can you walk us through the chart on Bitcoin? It obviously is inching up the last day or so, but it certainly isn't back to its all-time highs. Ethereum, ETH is even stalled out a little bit, right? And now some of the other altcoins are starting.
That's because it's a lot of time, baby. It's a lot of time.
It's like passing the torch, right? A relay race.
I think that's how it works. Listen, I've been saying that for weeks. I don't know if it'll be true, but that's my assumption. Just looking at these cycles and extrapolating what's likely to happen as people get bored and move their money. I mean, Bitcoin obviously had that pretty gratuitous top around 124. Right, came down as low as, the 107s, 108s. And I think 112 has kind of been that key level there. I just kind of have it as a zone here. But obviously, yesterday we're able to finally push through that after all these attempts and now running right into the 50 MA. Bitcoin is like the most technically driven chart you can generally trade of most assets. It's pretty incredible. Like you can basically say, hey, when it pushes through 112, it's probably going to stall at the 50 MA. And I think that's what we're having right now.
Yeah.
So I think that this is all kind of just sideways chop. Interesting, Mike. I'd love your opinion on this because you make the point often that Bitcoin kind of was leading the way down, but now we have Bitcoin has been really sideways for a long time, and everything else still going up.
Yeah, well, it's so important to go there because you mentioned it's also what's happening. You mentioned Solana or Ether or any other the other ones. that what's happening is what you said, they get bored because there's so much money sloshing in the system. I remember hearing the same quote in 1999 and 2007, and people are just looking what to do with it. But that is the key. Also, a key thing you said is very profound. Is Bitcoin is very technical. It is. Almost all these things are very technical. So it's just a giant casino. It's wonderful. I mean, compared to the days I was in a trading pit, I dreamed of a casino like this. But let's not underestimate what's happening. I want to tilt over to a headline I put out today because I've been waiting to put this out for a while, and I have to admit I'm doing it a bit to agitate and to antagonize. And I did compare that we do have, according to CoinMarketCap.com now, 21 million cryptos. Okay, we'll call them what they are. In 2009, there was one. And now there's 21 million. So that's what I think is happening to this space. It's commodified. It's being commoditized. And you can trade anyone you want. Treasurers are tilting away from Bitcoin towards the other ones. And the key thing I want to point out is that Bloomberg Galaxy Crypto Index versus gold has been basically, even though it trades 5 times higher volatility, is unchanged for 8 years. That's not a good sign. That's what I show you in this chart. But what's the same chart syndrome with this chart is the U.S. stock market overlaid with GDP. Let's not underestimate what's really driving everything. U.S. stock market is elevating. That's $4 trillion or so in cryptos. The problem is Bitcoin is becoming less of digital gold now. It's becoming just a commodity. But I want to also overlay that with just the Bitcoin gold cross. This is chart I've been worried about for a while because it's showing me the divergence that I'm supposed to look for as a strategist. You need to look for inflection points, look ahead of the market. It's the same right now as it first traded in 2021. Now, Dave Weisberger always likes to push back on this. But again, it's same chart syndrome with the U.S. stock market GDP. That's the wealth creation effect. And the way I look at this is a commodity traders, you want to sell at the upper end of the range. This is when President Trump got elected. We got another test near 31 and the Bitcoin gold cross. And you want to look for dips to buy. Why shouldn't it go back to 25 and just a normal rotation? To me, this is what might be happening in the fourth quarter. That's why I think the next few months are going to be so telling. Now, if we can stay at these levels and continue with low volatility and continue to appreciate as the Fed starts to cut rates and the economy, the labor market slows down for the recession most of us expected 2 years ago, we never got, that would be wonderful. I look at it just a trading range. You were supposed to be selling cryptos or Bitcoin versus gold a few months ago, and you should be waiting a while to be buying.
Can I ask you guys a question about AI and its impact? So Oracle reported earnings. The stock went up the most a large cap has ever gone up in one single day, from a $700 billion company. It went up as much as 42% intraday, closed up like 36%. But like, you know, I'm kind of starting to see this future where more and more jobs are replaced, like these lower paying jobs. And is that some vision that you guys are seeing as well, is where the unemployment rate starts to go up substantially, and the diversity between really rich, like people that are either AI programmers or people that own it, they just get like, I mean, trillion, like Elon Musk just got proposed his next pay package is going to make him a trillionaire, right? But then you have people that were working at McDonald's, which are going to be replaced by robots. And I mean, is that something that you guys are seeing? And number two is, is this enough to keep the economy, or like, what's the impact on the economy? Is it good or bad?
I could see it both ways, honestly. And I think it's one of those things where we'll see how it comes. I mean, I obviously think that inherently new technology should be deflationary. The price of goods should come down. People should not need to make as much money to live. They should have more free time, and we should have a renaissance of entrepreneurship. Read The Price of Tomorrow by Jeff Booth. If we didn't have a fixed economy and inflation as the system and fiat, that's what should happen. Your TV, your phone, every single item that you buy that is a piece of technology, as we've all seen over time, comes down in price. So everything should naturally come down in price because of technology, which would mean you need less money to buy those things and you have a better life. Doesn't work with inflation. So I would say that in a world where we have, economies based on fiat and inflation and monetary and fiscal policy, it will probably end up increasing the wealth divide, just like everything has over the last decades. When has the situation improved in your lifetime or recent memory for poorer people relative to wealthier people? I can't remember a time in my life when that's happened. So I do have concerns that because of the way the system is built, that it will just increase the haves versus the have-nots.
To some extent, I think a lot of that's true. It's certainly showing up with new college grads. They're having the unemployment's high. I think it's really enhancing the value of the trades. I mean, I don't know if an AI can do plumbing and electrical value. So that is what Trump's
that'll
on top
be the
of.
robots next in 5 years.
Well, there you go. The robots creating their robots. I just listened to a great podcast on All In with Elon Musk talking about the dexterity of creating a humanoid type robots. I mean, it's coming. It's happening fast, but it's going to be a while. The key thing I want to point out is we all knew what would happen, and we all expected the internet to change the world, and we all knew, well, back then, a lot of us knew these things I was trading, like I did some cryptos, were just silly, and you had to just trade them for fun. Once you doubled your money, take some profits. And we had the major flush, the correction, and now we show we can't live without the internet. I think that's going to happen in the AI, and that's the point I want to point out when I show you in the charts. When you get 2 times the GDP in the stock market, only 2 times that's happened in history, 1989 in Japan, in 1929 US, you got to be looking for alternatives. Maybe it's different. Maybe it can last a little longer, but this is only the first year it's done it. And that's why I keep looking for alternatives like gold. So my point is, that's a lot of that's priced in the equity markets, just like people have made the example of the railroad stocks. Some of them peaked in the 1900s, and some electricity stocks peaked then too, because the revolution, a lot of it's priced in. We do have the Mag 7, and the question is now, how much further does it go? Can we get through this period? First of all, can we get through 4 years of a Trump administration without a normal 20% stock market correction that stays down? I think it's very unlikely. You've only had 19%, and went poof and went right back up. So to me, that's what I'm looking forward to, is at some point we're going to get this normal reversion in elevated risk assets pricing, and how wonderful AI is. And then we're going to get the reality of, sure, it's going to eliminate jobs for a while. It's going to crush inflation, just like all technology does, which is probably why I'm still bullish bonds. Been wrong. And then we'll get to the point where we're going to look back from the future and say, after all the dust settles, and we'll be fine. But I stick with my call that, yeah, I've been way wrong on it. I think we're overdue for another 50% drawdown in U.S. stocks, only because they're way too expensive. I'm just waiting for the timing. And so far I've been wrong.
And they get more expensive. I mean, incredible, that move on Oracle. I mean, if you had told me the day before that a company could miss earnings, miss on revenues, they missed on both the metrics. But then, think about how silly this environment is. The company was like, oh, but don't worry, guys, like over the next 5 years, we're going to do so well. We're going to, to quote our president, it's going to be the best ever. Right. And then the market's like, oh, yeah, they missed on earnings and revenue, but let's believe them on this and push up the stock, $300 billion. Right. I mean, it's just so ludicrous.
What's the best way to make a market go down is squeeze the shorts. And that sounds to me like a pretty good short squeeze.
Well, and not only that, but Scott, something we talked about in the last few market mavericks. Have you seen how many of these stocks are repeating what whatever immersion technologies did? I mean, it's incredible. Let me show you guys some of these. It was, what was it? QMMM, this thing, 2,700% move. They said, I think they said they were going to buy some Bitcoin, Ethereum, and Solana. CWD gapped up, went up 2,400% intraday. They said, oh, we're going to buy some Chainlink and make it into our treasury. I mean, this stuff is ridiculous.
Pull up strategy. 325 now.
Well, Scott, you might be muted.
Yeah, it's as bad as the altcoin market was and peak hype cycle of the altcoin market. Listen, I'm wrong about a lot of things, but I was definitely one of the first people beating on the drum of the stock market is the new alt season, right? Anything crypto related in the stock market, that's where altcoin action's happening. That is alt season. I think it really started heavily with eToro and Circle, but these are how when we used to get an alt season, there was a lot of money at the top, Bitcoin, and then it would get bored and it would funnel down to Ethereum. And then you would see this great dispersion to kind of everything else, all the way down to the meme coins and back. The Doge pump was usually the last sign that it was time to get back into Bitcoin for the next part of the cycle, right?
You're right.
These are the meme coins. So we went from Bitcoin and ETFs, very serious. The Ethereum ETF started to do well. Circle, which is a legitimate company, doing well. And now you're seeing all that money find the stupidity.
So, Gareth, pull up strategy. The first of them all, the foremost, Mr. Saylor. I mean, the deity in the space, they're below the 200-day moving average, MicroStrategy. Last time that happened, it dipped below the 200-day moving average for more than a few days, was the beginning of 2022. Strategy had peaked around 100, like a couple couple months before, and it dropped to like the lowest was like 14. I don't see what stops it from going for 100. That's just normal technical analysis.
Mike, what you often say, I'm thinking about this in real time, but what you often say, which I disagree with, about there being millions of competitors to Bitcoin, I do agree there are a lot of crypto companies. I obviously don't agree they're all competitors to Bitcoin, but I do agree that treasury companies are competitors to MicroStrategy. So
well, they were the first one, right?
MicroStrategy definitely has a lot of other names in the market, as dumb as some of them are and as up and down as they go, that could take away a lot of the liquidity. I mean, I think that argument holds a little more water actually with MicroStrategy than it does even with Bitcoin right now.
So Garrett, you should be buying that right now. The way I see that is as a person, if I'm short and I'm bearish, I remember I bought Lehman at 2 because I was short everything else, and just because I needed to test it. That's a place to test along, and certainly if you get stopped out of the short, then you double down on getting short. But you should. I mean, is that what I'm wondering? What you're thinking there? Look at that chart, it's right trend line.
Right.
Yeah, I'm looking at it. It's really interesting.
I haven't. If this, I mean, right now it's still above support, so it could get a bounce. But if this breaks, watch out below. It probably.
I'm actually looking at it. I haven't looked at this chart. Pull mine up. I mean, it's pretty interesting. I think we mentioned this maybe last week, but the 50 MA on the weekly is now resistance, which I had not seen. And when you flip to the daily, if you are a moving average guy, you've got the 50 and the 200 above as resistance and both rolling over. Like I don't know. I actually like Saylor. I'm generally kind of a believer in MicroStrategy, but if you showed me this chart without a ticker on it, I would tell you to run.
Yeah.
It's purely technical, purely from a technical perspective. Like if this said, Skittles candy up in the top left corner, I would say you don't want to buy Skittles here.
Well, that's one thing I enjoy learning in the trading pit. Some of the best technicians I've ever met, most of them either dead or retired, they would deliberately ignore the fundamentals. They would get mad at you talking about fundamentals because it would distort their technical views. And sometimes ignore Mr. Sale. I think he taught me so much, but just look at that chart. What should I do with it? But the key thing is, what does it mean if it continues to break down? To me, that's the dominoes. That could be the first one.
Yeah, it's interesting. Fundamentals. I always say, what's that?
Yeah, I hadn't really looked at it, and I don't love it. Yeah.
No, it doesn't. Yeah,
probably needs to go up from here, right, Mike?
Fundamentals for me, they only work in like a neutral market, because like in a bull market like we're in right now, they don't make any sense. And then when you go into like a 2008, 2009, they don't make any sense. It's like it's only in that kind of neutral period where you're like, oh yeah, that's the proper PE ratio and like all this stuff. But too often it doesn't make sense, and it's hard to make a reason for why things are valued there. So yeah, so all right, listen, we have next week's Fed decision. I think, are we all on the same? Are we all agreeing there will be a rate cut of 25 basis points?
Yeah. Yep, yes. That's priced in, and then my Bloomberg terminal shows, if I can pull it up. It shows 100%. Doesn't really show anything more than that. What do we have? 107%. So it's just 25. But it does show, what I like to point out, if you get out to SEP 2026, we're already down below 3%. To me, that's the key thing, that the market's already pricing in that easing. It's pricing in that fuel. If we don't get it, that's a problem. And if we get more than that, it might be because the market's telling you you need more. But that's what the market expects. I mean, it's But for the meeting in September for next week, 25 basis points, 106%. So it's not far enough.
Do you guys think that? So there's people talk when Powell talks. People say Powell will speak hawkishly or dovishly, right? So they're going to cut, which is a little dovish. But do you think he's going to be more dovish? Will the market say, "Oh, this is good news"?
I think he's going to cut and say we're going to be data driven moving forward, and we have not made a decision on what to do. The data supports a 25 BIP cut here, but we'll have to see how inflation reacts and if there's any effects of tariffs, and if the labor market shows signs of strengthening.
You just showed his whole speech for next week.
Yeah, easy. But I didn't scratch my nose or sneeze in the wrong way, so.
Mike, you're old enough. I don't know if Scott remembers this, because I don't know if Scott followed the stock market. But remember Greenspan, how when Greenspan would walk into the Fed that day, everyone would look at his back, like his suitcase.
Briefcase,
and if it was like,
briefcase,
if it looked briefcase, if it was looked heavy, then it meant something. If it looked light, it meant something. Remember all that stuff?
Well, that's the thing that I really came of age when in the trading pits, being on the phone with clients, and when he spoke, his voice was just so soothing. And what I remember then, that was when I was really on top of the bull market in bonds, and I got it right. It helped me get out of the trading pits in Chicago to New York trading desks, and that's the number one thing that market I know the best that I've been wrong on the most for 2 years. But I just never forget that voice. It was just so soothing. Every time I hear it, I'm like, all right, guys, let's buy more bonds. It worked. Now it's like I don't know what to do with the bond market. And I used to know it well, and like I said, I'm trying again. We'll see if. And I'm worried though that this signals from gold are scary, and what we're going to see. And the thing is, what Trump's doing by battling the Fed so openly like this is every time I see him do that, I just think the gold market just smiles and says, "Thank you very much."
Yeah, and Scott and I were talking before we went on live that, in general, you don't see long periods of time where gold goes up to and making new all-time highs and the stock market continues. That they usually, like, they can travel short periods of time together, but it doesn't usually last. One of those breaks, and I think we're all in agreement that at some point probably the stock market breaks. So, all right, gentlemen, a great episode of Market Mavericks. Follow these gentlemen below. You can see their X handles just at the bottom of the screen. We will likely be back next Thursday for an all-inclusive Market Mavericks. We'll talk to you all then. Take care, guys. Thank you.